Everybody, let's get started. Welcome to our briefing for September 26th. We're happy that you're here. Hopefully there's some normalcy in the air with some fall, and thank God for football, huh? I hope you're all very happy and safe and healthy and doing well. I've got, as usual, Millie Robinson on our Zoom call with us today. I think at some point other team members, Clayton Kwame and Tom O'Gorman, will be on the call. At this time, I'll ask Millie Robinson, who is in the AP Wealth Management headquarters, world headquarters in Augusta, to take us through some technical instructions and tell us how we can forward a recording of today's briefing for those who might benefit from it. Millie, take it away.
Thanks, Gene. Hi, everybody. I hope you're doing well. If you'd like to submit questions during the briefing today, if you will look at the bottom of your screen, there's a toolbar and a pop-up box that says chat. So if you click that, the chat box will come up and you can submit a question that way. You can submit it to everyone in the group, or you can submit it to me, and I'll be sure that Jean gets the question. Also, this briefing is being recorded and will be available tomorrow on our website and also on social media. So, and we appreciate feedback.
Thank you, Millie. Hopefully it'll be good enough that you want to send it to somebody. Just an overview of what we do. We've got some new folks on the call. We'll talk for not more than 20 minutes, and then we'll have a question and answer session for as long as it takes. That typically runs about 10 minutes. But we want to be efficient with everybody's time. And the title of today is Fighting the Fed, how the Fed affects our financial markets. And the backdrop to this is, in our Investment Policy Committee meeting, Pat Fair made the comment, "Don't fight the Fed." And as we thought about that, we thought we should discuss the Federal Reserve and how it affects the financial markets. We pay attention to the Federal Reserve and thought you should too, and should understand their policies and how they affect interest rates in the financial markets, and they affect their fluctuations in interest rates affect our investment decisions and certainly affect the markets. So don't fight the Fed is a term frequently used as an investment approach. When interest rates are low, stocks will typically rise, and when interest rates are high, they'll usually likely retreat. And there's so much focus on the financial media on what the Fed does and what they say and don't say. We thought it would be valuable for you to learn more about the Fed and how their actions affect all of us. So let's get started. Let me share my screen here. Hopefully we've got a little bit of a new setup. I won't mess it up too badly here. Okay. Millie, we looking good on that? Okay, terrific. All right, so don't fight the Fed, the function of the Federal Reserve, and how their actions are affecting financial markets. As always, and I think it's really important today, on the right is our upside down triangle of how we approach investment management, and our cornerstone, as always, is asset allocation. Today, or any time that we feel the equity markets or the fixed income markets are not performing as they should, we may overweight or underweight an asset class, but we will not take people out of their asset allocation unless something has changed. And then, as always, total return is equal to income plus capital appreciation. We do have an opportunistic investment that, if we have time, we'll talk about at the end of today's briefing. So what is the Federal Reserve, or what are their purposes and responsibilities? And I'll refer to them as the Fed. The Federal Reserve is the bank of the United States. It's what banks and takes care of the financial transactions of the United States. It has four main mandates, and that is to influence money and credit conditions, to pursue full employment and a stable economy, regulate and supervise banks and financial institutions, maintain stability of financial systems and minimize systemic risk, and provide financial services to the U.S. government and financial institutions. So why are we talking about the Fed? Well, this is really interesting, and not necessarily in a good way. This is the yield curve And the dotted line shows where we were in 2013, at the end of 2013. So if you're moving from left to right, that's the time period or the length of a bond that you would buy. And the blue line shows where we are or were at June 30th, 2020. So if I can get my pointer working here, yeah, okay. Millie, can you see my arrow? Okay, terrific. I don't need to get the pointer working. So right down here, you can see on short term, this is the axis: 3 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 30 year. So as illustrated by this, the blue line, interest rates are still at historically low levels. So just by way of example, we often talk about the 10-year treasury. And the 10-year treasury back in 13 was at 3%. What that means is if you bought a US Treasury bond for 10 years, you would make 3% every year for 10 years. 7 years later, or just about 7 years later, that same return on a 10-year Treasury bond is now paying 0.66%. So the Fed doesn't affect all of this, but they certainly have effects on this, and they certainly have to deal with this. So with historically low interest rates as a backdrop, let's continue. The Fed has tremendous influence, and the influence of the Fed on the global economy cannot be understated. They are the US bank, but in many regards, they are the World Bank as well. And that's because the US dollar and the economy are still at the apex of the world economy. Although China is a very large economy, it is second by a large margin to the United States economy. And this is evident by careful and the nuanced communication from the Fed. So I'll just give you a couple of examples. The Fed is paid attention to so closely that I want you to see these quotes from the Wall Street Journal last week after the Fed met. And Jerome Powell, who's referenced here as Mr. Powell, that's who Mr. Powell is here. So quote, at Wednesday's news conference, Mr. Powell used the word powerful 10 times to describe the Fed's new guidance. Another quote, under its new framework, the Fed says that the following periods when inflation is run persistently below its 2% target, officials will want inflation to run moderately above 2% for some time. The Fed's policy statement adopted similar language on Wednesday. Mr. Powell, when pressed, declined to define these modifiers. So it sounds like a bunch of gobbledygook, but it's really not. It's that they're being super careful about the phrases and the nuances that they use, because whenever guidance or any communication comes out from the Fed, it affects not only the US markets, but it affects the world's markets as well. So the next time you want to see a quote or you want to read a little bit about the Fed, just pay attention to how bland at times and how nuanced their communication is. It's incredibly interesting. So I read to you the 4 mandates of the Fed, but as we think about the Federal Reserve or the Fed, what are the 3 things that the Fed really does? They set short-term interest rates, they affect long-term interest rates, and they disseminate pertinent information. And we'll dig into those just a little bit and not spend too much time on them. So they set short-term interest rates. What that means is the Federal Open Market Committee, the FOMC, or the Fed, that's how it's referenced in the financial markets and the media usually, meets 8 times per year and sets short-term rates and issues guidance. So what does that mean? Well, short-term rates are what banks charge each other to borrow money from each other because they don't always have capital reserves and have cash that they need, or especially in big transactions. So 8 times a year, it always gets pressed. You'll see the Fed's about to meet this week, or the Fed met last week, and that's what came out of it. And then they issued guidance. We'll dig into that a little bit further. They have a lot of information that they have if they're ready. And sometimes they share some of it, and sometimes they don't. And that's part of the nuances that we discussed. And their guidance is often illustrated by, as I said, setting interbank interest rates or the rates that banks pay each other to borrow money. So they set short-term rates. That's one of their functions. They affect long-term rates. And without getting too technical here, they can't, unlike a 3-year treasury or interbank rates that they determine, they can affect long-term rates by buying long-term bonds. And so you've heard about the Fed easing, you've heard about the Fed buying bonds. Well, because of supply and demand, that second bullet point there, if the Fed goes and buys a bunch of bonds, then that's going to affect interest rates and hopefully bring them down. Lately, they've been all buying. Interest rates are incredibly low. The Fed would like those interest rates to go up, but there's only so much that they can do. If you'll recall, in 2008 and 2009, the financial crisis, the Fed put a lot of liquidity into the market. They bought an awful lot of bonds so that they could try to get interest rates up and moving and inject cash into the economy. Were they successful? On the whole, looking back, they were. They disseminate pertinent information. There's a book called the Beige Book, and it is put out at every meeting or just before every meeting of those 8 meetings I referenced earlier. The Fed has information from a lot of sources that we don't, and can go get awful lot of information. So the Beige Book is usually delved into pretty hard to get some of that information, but also to find out what the Fed is going to do. From that Beige Book, in bullet point 2, they will provide an awful lot of guidance based on the information that they pulled out of the Beige Book. And the Beige Book can be things like unemployment, can be GDP, which is gross domestic product, which is a measure of how healthy and how much the economy is growing. There can be things on interest rates, certainly on inflation, how fast money is being spent, all those sorts of things. And of course, with the pandemic that we're in right now, that information is incredibly important and very unique as well. So one of the things that the Fed works around and the Fed uses is projections. Well, you can see the title of this, We Found the Problem and It Is Us. So if you look at interest rates, that's starting in 2010 to today, which is the blue line, and then the Congressional Budget Office will do projections. So that's in the northwest corner where the Congressional Budget Office says interest rates are going to go. So if you look at 2012, that's that first dotted line on the far left side, they saw interest rates moving up and then flattening out. And that's kind of their pattern. Well, boy, were they wrong, weren't they? Because they thought interest rates were going to move up and then flatten out. And year after year, they have been dead wrong. So when the Congressional Budget Office is wrong, it usually affects a whole lot of things, including some projections by the Federal Reserve. So that also illustrates, as you can see, the 10-year Treasury on the far left side in 2010 was just below 4%. Now, 10 years later, as I mentioned earlier, we're at 0.66%. It's just a nosedive in the last year or so. So how does the Fed really affect the financial markets? Well, of course, they change the interest rates. We talked about that. They change at their whim the short-term rates, but they can influence long-term rates by buying and or selling bonds. So what does that mean? Well, of course, when interest rates are low, like they are now, stocks are going to look more or less, they're going to look more attractive, or if rates jump up, they're going to look less attractive when compared to interest-bearing investments. By way of example, if I'm an investor and I know that I can make 0.6% on a 10-year Treasury bond risk-free, because if the government defaults on their 10-year Treasury bond, it doesn't matter how much money we have in the bank, we just need to have bullets or be able to defend ourselves. But when interest rates are this low, people are going to look to stocks, particularly dividend-producing stocks or income-producing stocks, and there's going to be a demand for those because nobody wants to lock in a 0.66% rate of return. So when interest rates are low, it's going to help the stock market, and that has certainly been a tailwind in this recovery moving forward, amongst other things. Stocks look more attractive when rates are low, like I just referenced. And the other thing that's really important, and I think you'll notice this, is real estate is cheaper when rates are low because it costs less to borrow. We'll use the example of someone buying a house and mortgaging their house. If they're going to have a $500,000 house that they purchase and interest rates are at 5%, their payment, of course, is going to be higher. These days, you can probably get 3% money, and so your payment's going to be lower, so you may be able to buy a bigger house or cheaper, depending on what you're wanting to do. And then the opposite of what I just mentioned a second ago, bonds are less attractive if interest rates are low. So right now, that's where we are. We're searching for yield and trying to be sensible about it, but it's very much a headwind because interest rates are so low right now. Part of that's affected by the Fed, part of that's not. The Fed would like to have higher interest rates right now, and they're doing everything that they can to do that. So I wanted to do a little projection here of where we thought and where other folks, particularly the Fed, thought rates were going. So this is 2021, 2022, 23, and then just the longer term. So you can see the projection by most everyone is in 2021, the Fed funds rate's not going anywhere. It's going to be exactly where it is. Moving out to 2022, there's not a lot of change. One person projects that the Fed funds rate might rise a little bit, but it's still going to be below 1%. And as we move out to 2023, there's a few other dots or folks that thinks Fed funds rates or the short-term rates might move up. And longer term, most everybody thinks things will normalize. I can't emphasize enough how historic these interest rates, how low these historic interest rates are. We've not seen this before, particularly in our lifetime. And some strange things are beginning to happen as a result of it, which if we have time, we'll touch on. So the bottom line here is the projection is for interest rates to stay low for a very long time. And we frequently get a question about inflation. If interest rates stay this low, inflation is not going to be a problem. So where is the debt headed for the United States? Well, this is by the CBO, which is the Congressional Budget Office, so I'll give them some leeway there. But you can see from 1900 to 2050, in 1900, the U.S. debt was very low. In World War II, naturally, it spiked because we had to finance a war. And you can see now as we move to the right, the pandemic, we're almost, as a percentage of gross domestic product, not a dollar value, but that's a great measure. We're almost where we were in World War II from the debt that we borrowed. What does that have to do with the Federal Reserve? Well, I said the Federal Reserve helps manage long-term interest rates and certainly controls short-term interest rates. One of the reasons that the government can issue this much debt, the flip side is interest rates are so low that it's not costing the U.S. government, i.e. us, a whole lot of money to have this much debt out. The problem comes when interest rates normalize and all of a sudden the debt service or the interest on that debt really begins to affect folks and the government. And you can see there's a slope going northward that the CBOE projects we're going to have even more debt outstanding. There's all sorts of schools of thought on how much debt we ought to have. This is not a time to get into that, but I thought that was very helpful. So that's our brief discussion about the Fed. Millie, do we have any questions about what we've talked about so far?
Not yet, Gene.
Okay. Well, while questions are being formulated, I mentioned we looked at an opportunistic investment. And so I'll tell you just briefly about that. We are underweight equities. We're not out of anybody's asset allocation. Underweight only means that we're on the low end of holding stocks for people. We think that we're probably not through with the pandemic and there's probably some other shoes to fall. We are also underweight bonds because of the low interest rates. So with this recovery or rise in the market from our lows in March, everything is done very well, particularly technology. One area that has not done well is energy. And you can see that as you go to the gas station to fill up your car. We made some purchases of energy because of really two reasons. One, it's still beat down. It's a long-term investment for us. It's not something that we're going to sell again in 6 months. But more importantly, the yield on an awful lot of energy investments is around the 7% area. So as I mentioned earlier in my comments about interest rates and looking for yield, well, when we compare a 7% yield on an energy stock or an energy investment to a 0.6% return on the US Treasury bond, it looks very attractive. Naturally, energy is going to be a little bit more risky than the US government bond. So we're just beginning to look for yield and think that makes an awful lot of sense.
Gene, it looks like we have a question, a couple of questions. The first is, how political is the Fed, and does membership follow the party in power?
Okay, great question. The Fed is not a political organization per se. It is structured so that it is completely independent. But as we know, over the last 6 to 12 months, our president has attempted to influence Jerome Powell, the head of the Fed. They are appointments to the Fed. But on the whole, although President Trump tries to influence, I would say they are very much apolitical. That does not mean they don't feel the pressure of various economic or political things, but on the whole, I think they're apolitical. Great question.
All right, and the next question, how are you thinking about correlation between asset classes?
Oh, great question. So let me explain what correlation amongst asset classes means. So typically, bonds, when stocks drop, bonds are going to improve because people are going to go look for safety in times of volatility. So as from an asset allocation standpoint, you want non-correlated assets so that it's almost like so when one moves down, the other moves up. What was really interesting this week was gold. Everybody's been talking about gold. Everything went down a couple of days ago, including gold. And typically that does not happen, okay? And in the financial crisis, there was some correlation among asset classes that typically are not. But on the whole, we use asset allocation to take care of correlation and try to get non-correlated assets, which in the long run helps. There are time periods when assets can be correlated, but for the most part, they're not. I hope that helps.
All right, I don't have any other questions.
Well, hopefully another question or two will come in. If they don't, that's great. That means I did a good job, I hope. When we would love your feedback on topics that you'd like to hear us talk about or open discussions about. It can be anything. Frequently, we'll talk about our investment policy committee meetings, which is where we sort of open up the guts of our portfolios. This topic came from our investment policy committee meeting. Don't fight the Fed. But we'd love to hear what you want to hear, questions that are on your mind. We're happy to dig in as much or as little as you want. We're good, Millie?
Let's see, we just had another question.
Okay.
Have you made allocations into the precious metals?
Well, that's a great question. We are not a precious metal group. We have not made allocations into precious metals. We think we can fight inflation through other means that are have some more value than gold, or there's many commodities, so there are many precious metals, so I don't want to pick on gold, but gold gets the most press. The value of gold is what's created by supply and demand, and that's it. Unlike, say, oil, where certainly it's affected by supply and demand, but we have to have oil to run our economy. So we have not made allocations to precious metals. Good question.
I don't have any further questions.
Okay, well, everybody knows our email address and our telephone number, or we can Zoom. We'd be happy to dig into any of these topics that you would like to at another session. And as Millie said, if you know someone who might benefit from this discussion, please let us know. Also, please give us feedback on how we can be better. Sometimes we try to take these complex topics and talk about them in a difficult way, but we're grateful for you. We're grateful for your attendance today and hope that you continue to be healthy and happy. Take care, everybody.